option strategies during a volatile market environment with Chris Prybal from Schaeffers Investment Research. He's their senior market strategist. And Chris, I see you went ahead and you shared your slides. Can you put them in present mode, please? And I'm going to bring you on right now. Chris, how are we doing?
Good, Spencer. How are you doing?
Doing fantastic.
All right, everyone. My name is Chris Prybal, representing Schaeffers Investment Research. As you can see from the headline, the subject, option strategies during market duress. I'm not going to bore you with a bunch of formulas or spreadsheets on option trading. Obviously, I do not know your personal portfolio and what you're trying to accomplish. So what I'm going to do today is just try to give you something informative, hopefully inspirational, and hopefully you get something out of it. Hopefully you learn a lot from this show. I've worked hard on it. The next screen here, the next slide, is Schaeffers Investment Research. We've been around for 40 years. We're celebrating our 40th year of business. We pioneered option trading analysis. We've been sending out the Option Advisor newsletter for 27 years. So from the beginning, when options started, Bernie was there. And I take great pride in knowing that, we have great depth of indicators and data sets. So it's a fun job. Schaeffers, if you don't know, we started the company and trademarked the company on an approach called expectational analysis, which what that is the triangulation of technical analysis, which you saw a little bit of that in the last slide. And then we apply fundamental analysis upon that. And then our biggest tenet is sentiment analysis. What is the options market telling you about the greed or the euphoria of the market or the fear? What is short interest telling you? What are the media headlines? What's just the overall sentiment, retail and professional money on Wall Street? The next slide here, if you don't mind. As we know, volatility, it's inherent. You cannot get away from volatility. Everywhere you go in life, you're gonna go through a cycle. You have your great times, and then you have your down times. But overall, it's one great giant cycle. There are small cycles, there are large cycles. Cycles are everywhere you look, whether you look at lunar cycles, the tides at the beach. Each planet has a cycle around either the sun or the earth. I could go on and on. Inflation goes through cycles. Equities go through cycles. We have seasonal cycles everywhere. Humankind has used celestial objects to try to predict the future throughout antiquity. This is nothing new. We've also used it to predict rainfall. We've used it to predict the best time for wars. And we've used it to try to predict financial gains, to try to predict the best time to get into the market. On the next slide, I don't know how many of the viewers are familiar with the 8-year Venus cycle. It was new to me. I didn't know if I wanted to present this slide today because it's kind of in depth, but here's the basis of the 8-year Venus cycle. Venus rotates around the Earth, and every 8 years, it will return to the same place that it was previously. And I'm not sure if Vladimir Putin knows about the Venus cycle, although with the V in the letter and Vladimir, perhaps he does. Let me give you an example. We're getting bombarded right now with media headlines regarding Russia. So 2022, I'm just going to leave up question marks there. But if you go back 8 years to 2014, that was the year that Russia invaded Ukraine and annexed Crimea. If you go back 8 years prior to that, that was the first time that Russia blocked gas supplies to Ukraine. I'm not making this up. You can get on the internet and prove this. If you go back 8 years prior to that, 1998, that was the year that Russia defaulted on their debt, devalued their currency, and caused a world of stink in the financial markets, so much so that the hedge fund long-term capital management actually collapsed, causing ripples across the globe. If you go back 8 years from that point to 1990, that's the year Iraq invaded Kuwait. It's also a year that the United States was in a recession. 8 years prior to that, wow, this was a crazy year. I'm going to have to take a drink here, but you'll know why. 1982, in Des Moines, Iowa, Ozzy Osbourne bit the head off of a live bat on stage. I mean, that's crazy volatile stuff right there. U.S. was also in a recession that year. And our 10-year interest rate, if you've forgotten, was at 15%, which is roughly 9 times what the 10-year rates are today. So if you think times are tough now, interest rates were a lot worse back then. Okay, 8 years prior to 82, that was a year that the United States, again, was in a recession, and that was the year that President Nixon resigns. I've also noticed this 8-year cycle corresponds with the midterm election year cycle, which everyone knows is the weakest of the 4 years if you look at data historically. Next slide, please. How are we looking on time here, Spencer?
We are in good shape. We got plenty of time here. We still got half hour. So
perfect.
Yeah,
I'll lengthen it a little bit. The next one here, obviously, prediction is very difficult for anyone, whether for professional managers, retail, anyone indeed. I've got a few quotes here that you guys might find of interest, but most people remember Yogi Berra saying, never make predictions, especially about the future. Kind of whimsical and comical. I tracked that back, and actually, Yogi's manager at the New York Yankees, Casey Stengel, he's actually quoted with saying that before Yogi Berra. If you go back 20 or so years in the U.S. administration, Harry S. Truman was quoted as saying, give me a one-handed economist. And what he meant there is that he was tired of economists saying, well, on one hand, this is going to happen. But then again, on the other hand, this potentially could happen. He said, I'm tired of it. Give me an economist that has one opinion. I found that great. Herbert Hoover actually made the same comments prior to Harry S. Truman, so you can give both of them quotes, I suppose. And then one thing I found in this research for this, as far back as 1875, in Cincinnati, Ohio, a man named Samuel Benner published a book titled Benner's Prophecies of Future Ups and Downs in Prices. I live here in Cincinnati. Schaeffers is in Cincinnati. So it was just weird to see something 150 years ago. People were trying to forecast prices for the soybean yields or for the corn yield or when the rainfall would hit so that they could manage their lives. So we've always lived in an area of cycles and prediction. Next slide, if you don't mind, please. In 2022, as we know, it's the year of the tiger. Too bad about the Bengals. It's been a rough week here in Cincinnati. Hats off to LA. Great team. I thought we guys had you there in the fourth quarter, but we could not stop number 10, Cooper Kupp, and it was infuriating to me. But how do we tame volatility here in the year ahead, 2022? Let me give you this quote. Napoleon Bonaparte, French general, going back to the 1800s. He said men are moved by only two levers, or two levers only, fear and self-interest. That sounds a lot like fear and greed to me today. And Napoleon was talking about that a long time ago. You may have also heard the quote, buy when there's blood in the streets. That quote was from 1848. Baron Rothschild. There was a lot of duress in 1848 in Europe. It was the year of the Revolution. Baron Rothschild was buying French bonds while the streets of Paris were red with blood. When asked, why are you buying now? He said, because this is the time. This is when you buy, during duress. You don't buy when it's a euphoric top. That's when you sell. Which leads me to the next quote of a gentleman who published a book, Financial Astrology, Lieutenant Commander David Williams, who served in World War I and World War II. Thank you to all military or families listening. I appreciate your support. I come from a military family, so it means a lot to me. Lieutenant Commander Williams also said that you buy during panics and you sell during booms. So this has been going on for quite a long time. If you could switch to the next slide, please. Bernie Schaeffer, my boss, mentor, provider of paycheck each week. Love Bernie. Here are a few quotes that he has used on using options in volatile markets. And the one that really sticks out to me is the one on the left there. You either shorten your horizon or you lengthen it. When you're trading an option contract that has a stated date of expiration in a volatile market, you either have to trade quickly in short-dated contracts, or you really have to lengthen your time horizon so that you can ride out this volatility. So that really was a prescient quote. I love that one to death. I use it every day. Another one that I'm stealing from the Option Advisor book that Bernie had written is options trading is a probability game. You win the game by diversifying your positions, using only a fraction of your total capital on any one trade, and winning big on your profitable trades. I've been on these Benzinga presentations. In the past year, I remember having, huge trades, 600, 700% trades, 500, 400% trades. So on those big trades, you really have to let convexity run. You have to just close your eyes. If it's up 10%, obviously you're good and your position may be up 50%. But who's to say tomorrow it can't be up another 10 or 15%? And that's when the convexity runs. Usually human emotion is like, I've got a profit. I'm going to take that profit and get out. But sometimes in options, when you have the big hits, you have to let them run because they make up for your losing trades. In options trading, usually you only bat about 350%, meaning 3.5 to 4 of every 10 trades are going to be winners. So you're going to have 5 to 6 to 7 losers on every 10 trades that you got to make up for. And the way to make up for that is to let your big hits run. Another basic tenet that Bernie had brought is that options trading, a basic tenet of options trading, is often ignored or forgotten. To be able to realize the rewards of the option market, you must be financially and emotionally capable of withstanding the ups and downs of the option marketplace. You will be wrong. You will be whipped out. You have to have internal strength and fortitude to get over these humps. Next slide, please. Whoever's running the slides, thank you very much for doing that. I appreciate that. Schaeffers Research at the top there. We have information on our website so that anyone can go and look for bullish option strategies, bearish option strategies, strategies to use in volatile environments. If you think it's going to be a sideways environment, we have strategies for that. And then hedging option strategies. So if you go to that top link, you can click around, look at all the slides and presentations, and that way you're not pressed for time on a presentation here for me to explain that to you. Next slide, please. Since everyone's listening and I trade options, what questions do I get on a daily or weekly basis, text, phone calls? What are people asking me right now? A protective strategy. Let's say you're long stock or you're long stock portfolio, but you want downside exposure to hedge off that risk. It may or may not be too late to hedge off that risk now, but let's say a few weeks or months back when the market was at a peak, you're like, this looks unsustainable. I want to do something to hedge in case the market falls. One thing you could do is a protective put. Say you own ExxonMobil or you own Apple. You can buy a put. It's kind of like an insurance contract. You're going to pay a premium. Think about that as a deductible. What you want, you really don't want it because you're hedging your overall portfolio. But if that particular stock falls in value, this option contract will pay off commensurate to how many you did to hedge your overall risk. So it's almost like feeling, the market's going down, but I'm making money on this put. So I'm kind of happy about it. I'm doing better than everyone else is doing that didn't have this. An added benefit is because you only can lose if you're wrong and the stock goes up. You only lose that stated principal or the premium or the deductible, and you still have unlimited upside after that event happens. So you're not losing out if your stock that you've had for a while continues to rally and you were wrong by buying put. That's what I'm trying to say there. You could also hedge this portfolio using a volatility instrument such as the VIX or a related derivative contract based off of the VIX. That way, market falls, these trades that you put on benefit handsomely, and you're going to have to close them out at some point, but you're making money while the market falls, which was your stated what you wanted to do. Another way to protect your portfolio or a stock is just to write an overhead call on the equity. You can write these in the next week. You can write them in the next month. You could do one that expires in 6 months from now. Your basic idea here is you're capturing that premium, that contract that you paid. You're going to keep that premium up until the point where your stock crosses over the strike price of the contract you sold. One thing, covered calls or selling calls or writing calls, one thing I've found is that you'll lose out on some winners. And what I mean by that is you'll sell an overhead call to try to capture 5 or 10% more over the stated time frame. But then if that stock goes up, you're forced to sell 100 shares at that price. Well, you have to remember as an investor, you have to get back into that stock to reestablish the original position. A lot of times you go into the weekend and you forget going to Monday or Tuesday that, I've got this cash in my account now, but I have to rebuy the 100 shares, and say it went up another 5 points. You're like, do I buy it here? Maybe not. And then you just lose out on your winners if you write overhead calls. Volatility strategies that I like. I'm a fan of long straddles and long strangles, which if you go on to the next slide, what you're trying to do on a straddle or a strangle is there's going to be volatility. Price action is going to fluctuate one way or the other. It's imminent. You just don't know which direction it's going to be. You can buy both sides of the option market. You can buy a call and buy a put at the same strike price, and that will be a straddle. And what you're doing there is you're looking for the price to move either direction by a lot. And that's where your profit potential is unlimited. So if we got into this example, 60 a share here, maybe it was Dow Chemical, around 60, and we're buying the 60 strike. And it would cost us $4 for both sides on a short dated move. If Dow Chemical were to be purchased or purchase someone else, or there's positive news or negative news, and it moves down by 5 points or 10 points, you would take that movement and divide by the 4 that you had paid, and that's your profit. So it potentially is unlimited using this return. Your biggest risk is that nothing happens and time value or theta decays on you, and you're holding this contract and you're going to have to close it, and you will have a loss at that point. You want to overpay. To avoid overpaying for options, compare the implied volatility of that contract against the historical volatility over a comparable time frame. If you're an option buyer, it's always a red flag if the IVs are significantly higher than historicals. Because if your IVs are that high, you're paying an extreme premium for that contract. You might actually want to think about selling if IVs are that high versus buying, but there's a different set of risk if you sell options. So I really don't advise our listeners to do that unless instructed to do so, or you do more research on the subject. On the strangle, it's more on the next slide. It's more of a U-shaped bottom instead of a V-shaped bottom. Because on a strangle, in the Dow Chemical example, you'd buy the 62 strike or the 63 strike option, and then you would buy the 56 or 57 strike put. So you got the 63 call and the 57 put. So you have a wider window instead of just the 60 strike. It may cost you less to do a strangle because you have this wider entry, but the same underlying formula, you need a huge move in price and you need it quickly. So when we're at volatile turning points in the market environment like we are now, as you see on the next couple slides, I think I'm done with strangles. I think you guys got the point of straddles and strangles. This chart, I updated this chart Thursday at 3:40 p.m. It doesn't reflect Friday's declines. But what I want you to see here on this chart, after we talked about cycles, and you can see a lot of short dated cycles in this chart, and you can see longer dated cycles in this chart. There's a lot of cycles in charts if you look for them. The SPY at this time, S&P 500 index, it was at 438 when I took this, and that blue line is a 500-day moving average. So why would I use a 500-day moving average? It's roughly a 2-year moving average. So a 500-day is kind of just you can see the overall trend from a longer term horizon. As you can see, as it should be, the blue line at the bottom has been sloping up. But you will also see the price action, the SPY, it has pulled back to this 500-day numerous times. And what I want you to see here is that right now, we're still significantly, even after Friday's declines, we're still about 12.5% above the 500-day. So I'm suggesting that the market could potentially pull back another 12 or 13% just to find this 500-day support. So while it's been a tough environment, and while you think, oh, this might be the dip to buy, or Russia, they may invade Ukraine, but usually wars are good for the U.S. stock market. Just remember, we're still overbought by this measure. We're still overbought fundamentally in many cases, especially in a rising interest rate environment. And the cycle of this, maybe there's a longer cycle that plays out throughout 2022 where it's not the best time to buy the dip. We just don't know. We don't have all the information, or we won't have it until the future. So it's just something to keep in mind. The next slide here, Spencer, how are we doing for time now, sir?
We're still in a good spot, man. We got as much as 20 more minutes here, so we're great.
Really? Man, I thought I was talking for a long time. I guess not. This last slide, what I'm trying to point out here, over to the right side, you'll see that spike. That's recently. This is post-COVID. But those spikes to the left side, those were 2016, 2017, 18, and 19. We have not seen the spike in option fear that we have seen historically. Now, I don't know if it's because over the past year or two, the government flushed us with monetary and fiscal policy support like we have never seen in this country to deal with the COVID. And I appreciate it, but a lot of that money went into the stock market, and it went into the stock market all at once. It went into the stock market when we were having a SPAC craze, meme stock mania. So it flooded into these names. And we've seen Kathy Wood on TV a lot trying to explain, these are revolutionary names. These are changes in technology. She must have a pretty long cycle on those thoughts. You still have to make money and have growing revenue to survive in a different interest rate environment that we had when interest rates were at zero. And as you can see from this chart, the option market has not really, in my opinion, had a flush moment where there's so much massive selling by the algorithms and by the computers that it's a clear and definable blood in the street bottom. I don't think we've had it yet. Personally, I hope we don't get the spike, but one must realize that the potential is there. The potential and the probability are probably higher than normal. So it's something to consider. I mean, the strangle and the straddle gives you exposure. Okay, if I'm wrong, the market goes up instead of down. Well, I'm still right. If the market goes down, I'm still right. So you play both sides, and you can, the S&P 500 as an example, you can put on different strikes using the strangle, so you don't have to play at the money. You can say, okay, let me go 5% out of the money, and let me go 5% on the other side for the put out of the money. So you can take a wedge out. And then if you get this gigantic move, something like 1987, you are covered. You've got a winner. You're not sitting there holding the bag wondering, man, could I have done more to prepare myself for the future outcomes? None of us know what Vladimir Putin is thinking and what he would do. None of us know how far the Fed will go in raising interest rates. I mean, I've seen some people say that there's going to be 8 interest rate hikes this year. That would be 2 full percentage points from where we're at by the end of the year. If those people don't think that's going to shut down economic activity in America, they're fooling themselves. That would cause the economy to slow down. Inflation would slow down, and then the Fed would have to pivot and say, hey, we're not going to raise interest rates as much as you guys are predicting. So 2022, it is the year of the tiger. It's going to be up and down. There's going to be intraday cycles. There's going to be long-term cycles. If you'd like to know more, Schaeffers Investment Research is the place. We have real-time alert services, so you can get our real-time trading ideas. You can go there for education. You can go for options content. We've got a lot of great stuff there on Schaeffers. And once again, I'd like to thank Benzinga and Schaeffers and you, Spencer, for putting me on here.
Yeah, we got a couple questions, Chris.
Okay.
Isaac is asking, because you talked about, selling and controlling your emotions. How does one control their emotions and let their winners run? I often find myself selling too early.
Most people do. I have as well. You've got to look at you're talking about a specific stock, correct? Like
I imagine he's had we like you said, we've all had this happen. So
you have to juxtapose the research that you have with the price action. The lady that you just had on there previously, technical analysis can give you reads, whether you're using Fibonacci retracements, whether you're extending those Fibonacci lines, one thing I like to do, Spencer, is a 4-in-1 chart. What a 4-in-1 chart is you have a monthly, you have a weekly, you have a daily, and then you have an intraday. And if you look at the specific equity over all 4 time frames at the same time, you can tell, well, yeah, I should get out here because there's a resistance level here. But then if you look at the daily or the weekly, you could say, yeah, but the all-time high was 2 times that level you're looking at. So you have to broaden out your time frame and your perspective. And then if the short interest was one of your primary drivers, you have to get a feel for how much of that short interest is covered and how much is left to cover, or whether the analyst ratings were one of your drivers. If there were 15 holds when you entered this trade and you're worried about getting out and now there's 14 holds, well, there's still 14 analyst community that could drive people into the stock by offering a buy recommendation. So you really have to take a lot of things into context. overall for the stock market, when your neighbors are high-fiving, when they're talking about how great the stock market's doing, when strangers are offering you advice on, have you heard about this company or have you heard about this company? That's usually signs of a top. When no one wants to talk about the stock market, when you go to a family party or a picnic and they look at you and they're like, don't talk to him because the market's been doing bad. That's the sign that you need to pour as much money as you can, because people are scared. I mean, if the Washington Post or the LA Times or Dallas Morning News ever runs a story on the stock market as their front page news article, that's a sign for you to buy the stock market. When newspapers that don't focus on financial media run financial media stories, that's a sign for you as a sentiment, as a contrarian, that the time has, there's too many people or not enough people in a trade, and that's the time you got to go.
I always think about, Chris, there's this sports blog that I've been reading since I was in college. I'm reading the sports blog for 10 or so years, and every day they do a little roundup where they just round up stories from around the internet, right? And all of a sudden in 2020, obviously the pandemic hit, and the roundup, which used to be weird sports or news stories, all of a sudden it was the Dow Jones dropped 500 points, and I was like, what? I'm reading about the stock market on my sports blog. This has never happened before. What is going on right now? Why all of a sudden interest, guys?
Yeah, why are they telling you about the stock market? You didn't go there for stock market news.
Right.
But now they're infiltrating you because it's a big deal.
Right.
One simple thing people can do,
yeah.
Google Trends.
Mm-hmm.
You can type in search terms and compare one versus the other.
Oh, yeah.
For instance, if you were to go in Google Trends and type in bear market compared to bull market over the past year or past 5 years, that will give you a feel for the sentiment from everyone on the internet, what they're searching.
Sure.
So that's a way you could do it. That's completely free way to, have your own sentiment indicator. Obviously here at Schaeffers, we have so many data points that we can diagnose and dissect, from a stock or sector point of view even. One of my favorite indicators of late is just taking a sector and then using that sector as a basket, and then using the put-call ratios or the call-put ratios on the entire basket, and then comparing that to price. And what you'll see is that when people rush into puts, that usually is the bottom or a trough. And when everyone is buying calls, that's when the price action starts to wane and turn over and roll over, and we start a new cycle. I'm telling you, it's all about cycles, Spencer.
Life's about cycles. Chris Prybal, Senior Market Strategist, Schaeffers Investment Research. Chris, thank you so much for joining us today on the bootcamp.
My pleasure, sir. I hope you have a great rest of the day. Thank you, all viewers.